In 1988, a 5-year-old bond trader in Los Angeles. California controlled $0 in his own firm. By 2008, $1, 3 trillion. By 2024, $10, 5 trillion, and had created a system of ownership so vast that it touches every product you buy, every stock you own, every retirement check you'll ever receive. His name was Larry Fink, and the system he built didn't die when markets crashed. It evolved. It spread. It consumed everything in its path and became invisible to those trapped inside it. This isn't conspiracy. This is documented history. The SEC filings exist. The shareholder reports are public record. The 13F forms are available to anyone with an internet connection. The academic studies have been published and peer-reviewed in the world's leading economics journals. 3 companies now control more wealth than any empire in human history. More than the British Empire at its peak. More than the Catholic Church in medieval Europe. More than the Medici banking dynasty that financed the Renaissance. More than the Dutch East India Company at the height of its power. BlackRock, Vanguard, State Street, together. They manage over $25 trillion in assets. That's larger than the entire GDP of the United States. That's more than the GDP of China and Japan combined. That's more concentrated financial power than has ever existed in human civilization. But here's what nobody explains. They don't just manage money. They own everything. Every major corporation, every sector, every competitor within that sector, Coca-Cola and Pepsi, Apple and Microsoft, Ford and General Motors, ExxonMobil and Chevron, Pfizer and Johnson & Johnson. The companies you think are competing, the same 3 shareholders sit at the top of every single one. Before we go through the 3 architects who built this system, you need to understand what invisible ownership actually looks like. Not in textbooks. In practice, not in theory. In your daily life, it doesn't look like a hostile takeover. It doesn't look like a single billionaire making demands. It doesn't look like government nationalization. It doesn't look like monopoly in any form you've been taught to recognize. It looks like quiet accumulation. It looks like passive index funds that vote on every corporate decision in America. It looks like 3 asset managers controlling more shareholder votes than any government, any union, any activist group in history. It looks like the systematic absorption of an entire economy into 3 portfolios. The cage is invisible because the bars are made of something you've been told to trust. Something you've been told is safe. Something you've been told is the smartest financial decision you can make. Your retirement fund, your 401k, your children's college savings, your pension. 3 architects, 3 mechanisms, 3 bars of a cage you were never meant to see. And in the final section, I'll show you exactly how this system determines what you pay for groceries, how much you earn at work, why prices keep rising while wages stay flat, and why no politician will ever challenge it. Let's start with the original blueprint, Los Angeles, 1988. Larry Fink was 35 years old when he experienced one of Wall Street's most spectacular failures. He was not a revolutionary. He was not an outsider with a vision to change finance. He was a bond trader at First Boston who had built a $1 billion mortgage-backed securities desk from scratch, a Wall Street star. A man who had made the firm hundreds of millions of dollars. A man whose colleagues called him a genius. Then he lost $100 million in a single quarter. The models were wrong. Interest rates moved unexpectedly. The complex mortgage securities he had pioneered turned against him. His career at First Boston was finished. He was 35 with nothing but spectacular failure on his resume. But here's what historians often miss about catastrophic failure. That loss gave Larry Fink something more valuable than success ever could. It gave him obsession. Obsession with risk management. Obsession with understanding every single asset in a portfolio down to the individual mortgage. The individual bond. The individual derivative. He would never be surprised again. Here's how Fink's mechanism worked. In 1988, he founded BlackRock with $5 million in seed capital and 8 employees in a single room. His pitch to investors wasn't about generating returns. It was about understanding risk better than anyone had ever understood it before. He built a computer system called Aladdin. Let me show you exactly what that meant. Aladdin wasn't just portfolio tracking software. It was the most sophisticated risk analysis platform ever created. It analyzed risk across every asset class, every market condition, every possible scenario, simultaneously. It ran 5,000 Monte Carlo simulations per night. It stress-tested holdings against 3, 000 possible market crashes. It could tell you exactly what would happen to a billion-dollar portfolio if interest rates rose 2% while oil prices fell 30%. By 1994, BlackRock managed $53 billion. By 2004, $342 billion. Other institutions began paying BlackRock just to use Aladdin. The Federal Reserve used it. The European Central Bank used it. The Swiss National Bank used it. Then came 2008, and something happened that would change everything. The financial crisis erupted. Banks were collapsing one after another. Lehman Brothers was gone. Bear Stearns was gone. AIG needed a $182 billion bailout. The entire global financial system was frozen with toxic assets nobody understood. But here's the critical detail that changes everything. The Federal Reserve and the U.S. Treasury needed someone who could analyze the toxic assets. They needed someone with a system powerful enough to understand what the failing banks actually owned. They called Larry Fink. BlackRock was hired to manage $130 billion in toxic assets from Bear Stearns and AIG, not as a private company seeking profit. As an official advisor to the United States government, the Treasury Department paid BlackRock $120 million in fees. They were advising the government while playing the game. Within 2 years, BlackRock doubled in size. In December 2009, it acquired Barclays Global Investors for $13, $5 billion, gaining control of the iShares ETF business. By 2010, BlackRock managed $3, $3 trillion. By 2015, $4, $6 trillion. By 2020, $8, $7 trillion. Those who questioned the arrangement were systematically ignored. The revolving door between BlackRock and the Treasury Department spun faster with each administration. Brian Deese went from BlackRock to the Obama White House. Wally Adeyemo went from Treasury to BlackRock and back to Biden's Treasury. The first bar of the cage was in place. A risk system so powerful that even governments depended on it. But they needed more. Let's jump forward to meet the second architect. Malvern, Pennsylvania, 1975. John Bogle was 45 years old when he created the most disruptive financial product in the history of capitalism. He was not an elite Manhattan banker. He was not a Wall Street insider with connections. He was the son of a family ruined by the Great Depression, a family that lost everything in 1929. He had spent 24 years at Wellington Management before being fired in a brutal boardroom coup, a man who had watched actively managed funds consistently fail to beat the market. His failure gave him clarity. His anger gave him purpose. Here's how Bogle's mechanism worked. On August 31, 1976, Vanguard launched the first index investment trust with a revolutionary premise. Instead of paying expensive fund managers to pick stocks and watching them fail, why not simply buy every stock in the market and hold them forever? Let me show you exactly what that meant in dollars. Traditional mutual funds charged 1 to 2% in annual fees. They charged trading costs as managers bought and sold. They charged sales loads of 3 to 5% just to invest. On average, they underperformed the S&P 500 by 5% per year after costs. Vanguard's index fund charged 0. 5%. No sales load. Minimal trading. On a $100, 000 investment over 30 years. The difference meant keeping an additional $140. 0 inches your pocket. Wall Street laughed. They called it Bogle's folly. They said no one would want a fund that guaranteed average returns. The fund raised only $11 million against a target of $150 million. But here's what nobody explains about index funds. When you buy an index fund, you're not really buying stocks in any meaningful sense. You're giving your voting rights to the fund manager. Every share of Apple in the Vanguard 500 index fund is voted by Vanguard, not by you. Every share of Microsoft, every share of Amazon, every share of every company in that index, you own the economic exposure. They own the power. This should have been the end of active management, but it wasn't. It was the beginning of the greatest concentration of corporate voting power in human history. Within 10 years, Vanguard managed $100 billion. Within 20 years, $600 billion. Within 30 years, $3 trillion. By 2024, over $9 trillion. John Bogle invented something he never intended and eventually came to fear. He wanted to democratize investing by cutting costs for ordinary people. Instead, he centralized voting power in 3 institutions: He wanted to free individual investors from Wall Street predators. Instead, he created a system where 3 companies would control more corporate votes than any entity in human history. Bogle himself warned about this repeatedly before his death in January 2019. In a 2018 Wall Street Journal article, he called index fund concentration a matter of grave concern. He warned publicly about 3 giant index fund managers controlling corporate America. He called for government limits on how much any single fund family could own. Nobody listened. The money kept flowing. The concentration kept increasing. The cage kept growing. The second bar was in place. But one escape route remained. Let's examine the third architect, Boston, Massachusetts, 1792. State Street Bank was founded as the first financial services company in the United States. For 200 years, it was a regional bank, a custody provider, a background player. It held other people's assets. It processed transactions. It was the plumbing of Wall Street, not the architect. Then came 1993, and everything changed. State Street launched the SPDR S&P 500 ETF Trust, ticker symbol SPY, the first successful exchange-traded fund in American history. Here's how State Street's mechanism worked. Unlike mutual funds that traded once per day, ETFs traded like stocks on an exchange. You could buy at 1000 a.m. and sell at 1005 a.m. You could trade with limit orders, stop losses, margin. They had the tax advantages of index funds with the liquidity of stocks. The perfect product for instant gratification. Let me show you exactly what that meant for accumulation. SPY attracted $500 million in its first year. By 2000, $30 billion. By 2010, $90 billion. By 2024, over $500 billion in a single fund. State Street's total assets reached $4 trillion. But here's the critical detail that changes everything. State Street, BlackRock, and Vanguard don't compete. They co-own the entire economy together. Look at any S&P 500 company's SEC filings. Check the 13F forms. You'll find the same 3 names in the top 5 positions. Every single time. Apple Vanguard 8, 7%. BlackRock 6, 5%. State Street 3, 8%. Microsoft Vanguard 9, 0%. BlackRock 7, 3%. State Street 3, 9%. Amazon Vanguard 7, 1%. BlackRock 6, 4%. State Street 3, 2%. Alphabet Vanguard 7, 6%. BlackRock 6, 1%. State Street 3, 3%. JP Morgan Chase Vanguard 9, 1%. BlackRock 6, 8%. State Street 4, 5%. And here's where it gets darker. They don't just own your favorite companies. They own the competitors simultaneously. Coca-Cola and Pepsi share the same 3 largest shareholders. Delta, United, American, and Southwest Airlines share the same 3 shareholders. Bank of America, Wells Fargo, Citigroup, and JP Morgan share the same 3 shareholders. ExxonMobil and Chevron, Pfizer and Merck, Home Depot and Lowe's, CVS and Walgreens, AT&T and Verizon, every industry, every competitor, the same 3 owners. A landmark 2018 study by economists José Azar, Martin Schmalz, and Isabel Tekiu examined airline pricing. They found ticket prices were 3 to 7% higher because of common ownership. When competitors share the same owners, those owners have no incentive for price competition. Why would Vanguard want United to slash prices and hurt Delta when Vanguard profits from both? A follow-up banking study found similar results. Deposit rates were lower, loan rates were higher, the same shareholders extracting value from both sides. Those who questioned this faced a devastating reality. There's no law against it. Antitrust laws were written in 1890 and 1914 for horizontal mergers. They never anticipated 3 passive investors quietly accumulating stakes across every industry. Within 30 years, State Street, BlackRock, and Vanguard became the largest shareholders in 88% of S&P 500 companies. Not through hostile takeovers, through your retirement contributions flowing automatically into index funds. The third bar of the cage was complete. Here's where the pattern becomes permanent. New York City, 2024. The Big Three now collectively control $25 trillion in assets under management. 1/4 of all professionally managed assets on Earth, more than 22% of voting shares in the average S&P 500 company. In many corporations, their combined stake exceeds 25%. They are the single largest voting bloc, permanent seats on governance committees at virtually every major corporation. When they speak, CEOs listen. When they vote, policy changes. But they don't call themselves owners. They call themselves passive investors. They claim they simply follow the index. Here's the specific mechanism that reveals the lie. BlackRock employs 50 people in its investment stewardship team. These 50 people vote on 17,000 shareholder proposals per year across 4,000 companies worldwide. That's 340 decisions per employee per year, 3 minutes per decision that shapes corporate policy for millions of workers. They vote on executive compensation. They vote on board members. They vote on mergers and acquisitions. They vote on environmental policies, labor practices, political donations, and they vote almost always with management. In 2023, BlackRock voted with management 94% of the time. Vanguard voted with management 95% of the time. State Street voted with management 93% of the time. That's not passive investing. That's passive control. Let me show you what that means for workers and consumers. When the same shareholders own every company in an industry, what happens to wages? They stay suppressed. Why would competing companies bid up labor costs when the same owners benefit from lower wages across the sector? A 2022 study found common ownership reduced wages by approximately 10%. What happens to prices? They rise together. Why would competitors undercut each other when the same owners suffer from price wars? What happens to innovation? It disappears. Why take bold bets when your largest shareholders own everyone who might be disrupted? This isn't conspiracy. This is incentive structure. The FTC held hearings in 2018. The DOJ opened investigations. European regulators raised alarms. Nothing changed. Now let's examine what this ownership structure means for your daily life. In 1976, index funds held 0.4% of the U.S. stock market. Today, passive funds hold more than 54% of all domestically invested equity. Check. In 1990, the Big Three managed $200 billion combined. Today, they manage $25 trillion. That's a 125-fold increase in 34 years. Check. In 1980, the largest institutional shareholder in a typical company held 3 to 5% of shares. Today, the Big Three combined regularly hold 0.25% in most major corporations. Check. In 1970, the average American household didn't own stocks in any form. Today, 58% of Americans own equities, almost entirely through funds controlled by 3 companies. Check. In 2000, corporate CEOs still feared activist shareholders who might challenge their decisions. Today, the only shareholders that matter are BlackRock, Vanguard, and State Street, and they almost never challenge anything. Check. In 1960, there were 25 major airlines serving the United States. Today, 4 airlines control 80% of domestic flights, and all 4 are owned by the same 3 shareholders. Check. In 1985, there were dozens of major banks serving American consumers. Today, 4 banks control 44% of all deposits, and all 4 are owned by the same 3 shareholders. Check. We're not approaching the pattern. We're deep inside it. We're living in a world they designed. You wake up and check your iPhone. Apple's largest shareholders, Vanguard, BlackRock, State Street. You drive to work in your Ford. Ford's largest shareholders, Vanguard, BlackRock, State Street. You stop for gas at ExxonMobil. Exxon's largest shareholders, Vanguard, BlackRock, State Street. You buy lunch at McDonald's. McDonald's largest shareholders, Vanguard, BlackRock, State Street. You buy groceries at Walmart. Walmart's largest shareholders, Vanguard, BlackRock, State Street. You pay with Visa. Visa's largest shareholders, Vanguard, BlackRock. State Street. You deposit your paycheck at Bank of America. Bank of America's largest shareholders, Vanguard. BlackRock. State Street. You invest in your 401k. The funds available are managed by Vanguard. BlackRock. Or State Street. You cannot buy groceries without enriching them. You cannot earn a salary without paying them. You cannot save for retirement without funding them. You cannot heat your home without their involvement. You cannot access healthcare without their ownership. You cannot communicate without their presence. You cannot escape their system because there is no outside. Every dollar you earn flows through their architecture. Every dollar you spend returns to their portfolios. And you cannot escape it. 3 architects, 48 years. 1 cage. Larry Fink created the risk system that made governments dependent on his analysis. John Bogle created the accumulation mechanism that centralized voting power into 3 institutions. State Street created the liquidity tool that made the system irresistible to every investor on Earth. Each piece built on the last. Each piece made escape harder. Each piece seemed beneficial in isolation. Together, they created an ownership architecture you were never meant to see and cannot easily escape. They won't teach you this in any classroom. They'll teach you that index funds are the smartest way to invest for retirement. That passive investing consistently beats active management. That diversification across index funds protects your wealth. That the stock market is a democratic expression of economic value. That competition between corporations benefits consumers. But the architects knew better. They understood what they were building. Larry Fink told the New York Times in 2018, "We are asking companies to embrace a longer-term approach to creating value." When the largest shareholder in every major corporation asks, it isn't a polite suggestion. It's an instruction that will be followed. John Bogle himself wrote in 2018, "I do not believe that such concentration would serve the national interest." The man who built the machine warned us about what it had become. Nobody listened. The SEC filings exist. The 13 F forms are public record updated every quarter. The ownership stakes are visible to anyone willing to look. The academic studies have been published and peer-reviewed. You cannot vote your way out. Politicians receive donations from corporations owned by the Big Three. You cannot invest your way out. There is no retirement fund they don't touch. You cannot buy your way out. There is no product from a company they don't own, but you can see it now. And seeing it changes everything. The next time someone tells you the market is free, ask them who owns it. The next time someone tells you competition keeps prices low, ask them who owns the competitors. The next time someone tells you to invest in your future, ask them where that money actually goes. The cage has no door, but now you can see the bars. Welcome to Larry Fink's world.